Okay, I know that last one was pretty long. Chapter 3 will be a little bit quicker. We're going to talk through the financial environment, so the markets, institutions, and some investment banking. Um, Financial markets represent a system that bring together borrowers and savers. So just like any situation where you've got kind of folks that have on one side and folks that need on the other, it that's a marketplace where those that have and those that need are brought together and you exchange something of value and determine a price. Financial markets are exactly that. And in this particular case, they bring borrowers who have excess or who have a need of money and savers who have excess money together, and the borrowers pay the savers in order to be able to actually utilize their money. The primary role of financial markets is to facilitate flow of funds from those who have surplus to those who need. So let's talk a little bit about the flow of funds. There's three phases in a typical life. If you're young, so from the time you're essentially graduating from high school through your um, generally childbearing years into your 40s, you're generally going to be a net borrower. So you may save some and you may have a 401k or an IRA, but in general, you're going to be a net borrower. Older working adults, so once you've kind of moved through those childbearing years and you generally have two income family, your kids are out of school or out of college, so you might be in your late 40s to early 50s, you're generally going to be a net saver. So you're just saving a lot of money. You bought your house a long time ago. You're paying down on a mortgage, something that where inflation is likely mitigated that mortgage payment. So you're going to have net savings, and you're going to be putting money aside. And then retired adults will use their savings in order to be able to support their lifestyle following their stopping work. Funds are transferred from savers to borrowers in three different ways. Really, a direct transfer where there's a literal handing over between the borrower and the saver. Then you've got investment banking, where they facilitate generally the sale of businesses and securities between one and the other and into the financial markets like the New York Stock Exchange. And then you've got a financial intermediary who's going to be like a bank or a credit union or other financial institution that facilitates essentially pools of borrowers and pools of lenders, and the intermediary facilitates the transaction, and actually the borrowers and the lenders never really know each other. And so each one of these elements are pretty critical to the financial markets, and you'll learn more about it in your money and banking class. So here's a little diagram of the capital formation process. Again, direct transfers, you've got a business who's the borrower, you've got savers, the investors, and the funds will flow this direction. For indirect transfers through an investment banker, you've got the business and the saver. There's the stocks and bonds, and the money flows, essentially, the securities flow from the business through the investment banker to the saver. And then the funds flow from the saver through the investment banker to the business. However, the saver and the business know what the investment is. So they know each other, they know what the investment is. The investment banker essentially facilitates a transaction. In a financial intermediary, the intermediary holds liability and assets. So the saver, the investor, has an account at the intermediary. Think of the intermediary like a bank. The saver puts their money in the bank. The funds are loaned to a business, and that business owes the money back to the financial intermediary, and the financial intermediary pays interest to the saver, and then the financial intermediary will make a spread, net interest margin, between what they've loaned to the business and what they pay in interest to the saver. So market efficiency. Ideally, you're seeing economic efficiency in efficient markets. So funds are allocated to their optimal use at the lowest cost. Interest rates adjust so that available funds are just sufficient for those who can afford the cost of money. Essentially, interest rates are a reflection of expected inflation rates plus credit risk. And so you should have, when you've got an efficient market, the funds go to their optimal use at the lowest possible cost. So you've got a market clearing price, and then interest rates are going to adjust for the cost of money. Informational efficiency is that the investment prices reflect full information. And there's three predominant theories of market efficiency. You've got weak form, which is that all information from history is contained in the current market price. You've got a semi-strong form where current market prices reflect all history plus any publicly available information. And then you've got strong form efficiency where the current market price reflects all information, both public and private. And there's a lot of studies that have been done on market efficiency. And generally, when you're thinking about things like the stock market, your larger stocks generally have very close to a strong form efficiency. And then when you've got companies that are lightly traded or privately held, it goes more toward a semi-strong or weaker market efficiency. There's a few financial markets that provide kind of the market clearing between savers and borrowers. Money markets are markets that essentially have large issuances by large corporations for very short periods of time, and those transact between large institutional investors and large institutional borrowers. You have capital markets, which are more similar to the New York Stock Exchange or NASDAQ or London Stock Exchange, where the market is far more open to other participants. Debt markets. So in debt markets, you're going to have transactions in debt, which are going to largely be bonds, money market accounts, or money market instruments. And you've got equity markets, which are generally going to be your stocks and preferred stocks. Primary markets versus secondary markets. Primary markets are the initial sale of securities. Secondary markets are sale of securities that have already been issued. So your primary market is the first time a stock is issued, it's sold into the primary market. And then secondary markets are the sale between two individuals without interacting with the original issuer of the security. And derivative markets are markets like the Chicago Board of Options Exchange, where you have derivatives. And derivatives have gotten a bad name of late, but they have a real value, which is understanding they're priced off and derived, their price is derived, thus derivative, from some other instrument. So you may have a derivative that looks at the price of orange juice. And so there's going to be people on one side thinking the price of orange juice might go up, and others that the price on orange juice might go down. And so they buy or sell options to purchase or sell orange juice based upon some future point in time, betting the commodity is going to go up or down. Same thing with stock options, same things with interest rates. So the value of that option or the value of that derivative is driven by something other than that specific security. It's derived from another security. So general stock market activities, we've talked a little bit about this. There's a secondary market, which is trading in outstanding previously issued shares. One investor trades with another investor and it clears through the market, as opposed to the primary market, which are shares sold directly by publicly owned companies into the market. Investors purchase from the companies, either directly or indirectly through the investment bankers, and provide the company additional funds so that the company can then invest. And then you've got the IPO market, which are new offerings held by privately held firms that are going public with their shares. So it's the first time that company has issued stock available for the public to buy. Stock markets, there's a few major ones. You've got physical stock exchanges where people literally are on the trading floor and they trade between each other. New York Stock Exchange, the American Stock Exchange, regional exchanges. So there's San Francisco Stock Exchange, Boston Stock Exchange, Philadelphia Stock Exchange. The exchanges have members. So you've got floor brokers who essentially facilitate the trade from the investor on the floor. You've got designated market makers, and the market makers essentially are assigned a stock or specific set of stocks, and their responsibility is to determine what the price is. They measure who wants to buy and who wants to sell, and then they determine what the price should be, and they provide a market clearing price. Those are your specialists, and then you've got supplemental liquidity providers. If the specialists are overwhelmed, supplemental liquidity providers can come in and provide additional liquidity into the market. To have a stock listed, you have to apply to the exchange and meet the exchange requirements, pay a fee, and at that point, and you're also going to be filing with the Securities and Exchange Commission a bunch of required filings so that people understand what your business does, and then it's going to be issued as an initial public offering, and then it'll begin to trade utilizing the floor brokers and the specialists. So we talked a little bit about the over-the-counter markets and the NASDAQ. That's a network of brokers and dealers. That's an organized investment network as opposed to a physical location that trades. And the computers, electronic communications networks, ECNs, tend to handle the trading between participants on the NASDAQ, and you don't have human intervention. As I just mentioned, the Securities and Exchange Commission oversees and regulates securities markets. And so the SEC is part of the federal government. They have jurisdiction over interstate offerings of new securities to the general public. If you're going to sell outside of a specific state, you've got to get registered with the SEC. They regulate all the exchanges. They have the power to prohibit manipulation of securities prices, and they're the ones that will enforce insider trading. And they control stock trades by corporate insiders. So they have areas where there's blackout periods where corporate insiders are not allowed to trade around earnings releases, both before and shortly after an earnings release, as well as they require corporate insiders to report all their trades, and so you can see whether insiders are buying or selling. The investment banking process, we talked through this a little bit as well. The investment banker helps the corporation design securities that investors are going to want to buy. So that may be at what price, what voting rights, what liquidation preferences. We'll talk through some of those things as well. But they help design those securities. They help design the bonds that are going to be floated if the corporation is going to float bonds. Normally, then the investment banker buys the securities from the corporation, and again, there's a lot of different flavors to this, but for the purposes of this discussion, they'll buy it. So they may say, we think that this stock could sell at 10. They may go, we're going to buy all the stock from the company at 9, and then they resell the securities to the investors at 10 and make money on that spread between $9 and $10 a share. So raising capital, the first set of decisions that the investment banker is going to help the company work through are how much money are we going to raise? How are we going to raise it? And the company is generally going to start making some of these decisions, selection of the investment banker, and whether it's going to be a competitive bid versus a negotiated deal, both for the banker as well as the issuance. That's a process that is normally handled by the board of directors of a company, the chief financial officer and the chief executive officer. And you've got these first stage of decisions that are going to be made as part of the investment banking process. Then you've got your second stage of decisions, which are determining, once you've brought on the investment banker, you're going to reevaluate the initial decisions based upon the investment banker's recommendations as well as the current market conditions. And then you've got, as I had mentioned, there's a little bit of a different flavor here. Best efforts are underwritten issues. So the investment banker will either be retained on a best efforts basis or on an underwritten basis. If it's underwritten, the investment bank guarantees the sale by purchasing the securities from the issuer. If it's best efforts, the investment bank doesn't guarantee that all the securities will be sold, but they will make their best efforts to get them sold. So in one case, the investment banker will buy everything and then resell it, and that's an underwritten arrangement. In a best efforts arrangement, the investment banker essentially facilitates the transaction but doesn't own it. There's also going to be flotation costs, and that flotation costs are going to be negotiated with the investment banker. And if you have an underwritten arrangement, you may have flotation costs that are going to be lower because the investment banker is going to make money on the spread. If it's best efforts, flotation costs may be a little bit higher. And then you're going to set the offering price. So at what price do we think that the bond or the stock? In a bond, it's generally going to be a percent. On a stock, it's generally going to be a price per share. That we're going to offer this to the market, where you're trying to ideally find the market clearing price where everybody is happy to have transacted. The company's transacting at the highest possible price, and the investor is paying exactly what they want and no more. So in this particular case, you've got net proceeds and flotation costs, which are going to be a decimal. And so you've got a example here. A firm needs $470,000 and flotation costs are 6% of the total issue. So in order to determine how much money the flotation needs to be, you can look at it this way. If a firm needs $470,000, but 6% commission or 6% flotation costs are going to be paid to the investment bank, how much do they need to sell? So if they need $470,000 and the flotation costs are 6%, you're going to subtract 0.06 from 1 to come up with $500,000. So if you think about it this way, if $500,000 is issued and you have to pay 6% commission, so multiply 500,000 by 6%, that's $30,000. So 500,000 by 6% in flotation costs will be paid, which leaves 470,000, which was the amount that was needed for the firm to use as part of their investment process. Once you decide that you're going to sell securities or sell a business, you've got the selling procedure. So you've got an underwriting syndicate, which is a group of investment firms or investment banks that are formed to essentially spread the risk around. So you might do $1 billion issuance. In the case of Saudi Aramco, which just went public a few weeks ago, there's $1 trillion issuance. No one investment bank is going to be willing to take that on, even if it's an underwritten issue. And so you've got an underwriting syndicate, essentially, that'll be spread across a number of different investment banks, and each one will have a percentage that they're going to take of that initial offering. But you're also going to have a lead underwriter or a managing underwriter, which is the investment bank that is in the lead position and really allocates out to the underwriting syndicate how much they're going to get. And they're generally going to take, the lead is generally going to take the most, and they're generally going to be the primary interaction with the company. Then you've got a selling group, which is a group of brokerage firms that are pulled together to distribute the new issuance of securities. So you've got the underwriters, and then you've got the selling group. Generally, you're going to see that the selling group is going to include the brokerage arms of the investment banks that are part of the underwriting syndicate, but you may have other brokers in that mix as well. You've got shelf registration. So again, this is if you have a company that you're thinking you're going to have go public, but you're waiting for the markets to be right, or you're waiting for a product release or some other piece of news, You may do a shelf registration where you essentially pull all the information together, you get all the work done, the disclosures made, you put it on the shelf. You register it with the SEC, and you say, we're going to hold this on the shelf and we're going to sell it later when the market conditions are right. And it's held on the shelf until sale. When you've got a secondary market, or once you make a stock issuance, you want to make sure that you've got a secondary market. And that secondary market, essentially, as we talked about, you got the primary market, which is that initial issuance from the company to the investors. But stock is valuable only when you've got a good, robust secondary market where the current investors and new investors have an opportunity to transact. And so the maintenance of a secondary market is very important in order to keep a stock robust in trading. And so when a company is going public for the first time, the investment banker has to maintain a market for the shares after it's been completed. And generally, that's the lead underwriter says, we will make a secondary market and ensure that there's an opportunity to keep the stock liquid for a while until the market kind of begins taking care of itself. So that lead underwriter takes some risk in essentially stepping in and saying that they'll make a market, and what they then do is someone says, I want to sell 100 shares, and you have to find someone who's willing to buy the 100 shares, or they buy the 100 shares themselves. And generally, they're going to put a spread, what's called a bid-ask spread, between the amount that they're willing to pay, which is what they're willing to bid for the stock, and an ask, what they're willing to sell the stock for. They'll make money on that difference. We talked a little bit about financial intermediaries. These are, unlike investment banks, these are folks who pool funds from investors and then invest them or lend them to borrowers. But normally the borrower and the lender don't know, or the borrower and the investor don't know each other. So there's no real relationship between the borrower and the investor. Where in the investment banking, the investor and the borrower, the investor and the company invested in, the investor knows who that company is. In an intermediary case, they do not. And those intermediaries are commercial banks, credit unions, savings and loan institutions, mutual funds, and again, with kind of one exception, with the exception that in the mutual fund, you do know what the investments are, but you don't have any discretion as to what they are except to exit the mutual fund. Whole life insurance companies and pension funds. So the role of financial intermediaries is to facilitate the transfer from those who have funds, net savers, to those who need funds, net borrowers. And they manufacture a variety of financial products that take that form, whether they're loans, whether it's whole life insurance, variable life insurance, mutual funds, certificates of deposit. Those are the products that they manufacture in order to be able to have the net savers funnel their money through the financial intermediary to the net borrower, and the financial intermediary makes money on that spread. There's some benefits to financial intermediaries for both the net borrower and the net lender. The first one is it's reduced costs because the financial intermediary makes money on the spread. The cost of issuance, if you're a net borrower, it's a little bit lower because you're essentially dealing with one intermediary. You're getting a loan from a bank as opposed to having to go through the process of SEC filing, etc. But again, because you're dealing with one intermediary generally, again, with some exceptions, it's difficult to get the big numbers. If you're the net lender, you've got, or net investor, you generally are dealing with an intermediary who's given you a certificate of deposit, so you don't have to underwrite each of the loans yourself and determine whether you want to be in this building or that building's mortgage, etc. That's handled by the intermediary, so the costs are lower. You have diversification because you essentially are part of a pool. So as the net investor, you put your money in a bank. The bank pools all that money and then makes loans. And you have just a small slice of each one of those loans rather than having all your money in one loan or one basket. And in some cases, particularly with banks, credit unions, thrifts. You have federal insurance up to $250,000, $500,000, so you're not going to lose your money beyond that amount. We've talked a little bit about the funds divisibility and pooling. So again, they're able to pool funds and make smaller loans than would be economically feasible for an investment bank to put together. You've got more flexibility in that they can have large or small loans and other borrowings. And on the net borrower side, you may have equity investments, you may have debt investments, hybrid investments. They're able to invest in or lend to anything ranging from unsecured loans and direct investments for equity to secured mortgages and preferred stock. So there's a lot of flexibility on both the borrower and the lender side. And then you've got related services. So you're going to have the insurance wrappers attached. You may have checking accounts, savings accounts, and other additional services that allow the net investor to be able to get some additional benefit. Same thing on the borrower side, where they may have insurance and or asset management services, et cetera, on the net borrower side. International markets, I'm just going to touch on briefly. U.S. stock markets represent 40 to 45% of the U.S. Or of the total value worldwide of stock markets. So that means 60 to 55 to 60% of all value is outside the U.S. And while U.S. markets dominate, there's a lot of benefit to diversification offshore. Historically, the U.S. regulations have been more heavily regulated than offshore. The exception is the EU. And the U.S. financial institutions have had greater limitations on branching with banks, on banks offering investment, so traditional commercial banks offering investment banking services and relationships with non-financial businesses. I had talked in the chapter 1 about how Mitsubishi as a bank plus a manufacturing component, you're not going to find that in the United States. However, with the Gramm-Leach-Bliley Act passing back in the 90s, a lot of these barriers between investment banking and commercial banking have become quite a bit looser. And some of what you hear in the discussion around re-regulation in the presidential debates, for instance, are going back to, do we need to have additional firewalls after the 2008 financial crisis and the aftermath of putting additional regulation around the ability for banks and other financial institutions to participate in investment banking and vice versa. And again, what you tend to see is when financial markets don't do well or when you have a crisis, Congress will jump in. And so when Enron failed, you then had Congress jump in and put Sarbanes-Oxley in place. And that essentially drove additional regulation. After the 2008 financial crisis, you've seen bank stress tests required so that banks have to have additional capital requirements and additional testing. And so when financial markets go bad, Congress will jump in. When financial markets are performing really well, so you think about the long bull market from the early 80s up through the early 1990s, that's when Congress passed things like Gramm-Leach-Bliley that pulled a lot of regulation out. So Congress tends to be the lagging indicator. Normally there's a problem, then Congress regulates, then Congress gets to the point where the markets are doing really well, and folks have said, well, you've over-regulated. They pull the regulation off. The markets then at some point will have another financial downturn, and Congress will put additional regulation on. And so that cycle has continued since the 1800s. with much more veracity since the Great Depression.